Hey guys, welcome back to the channel. Today we're going to be talking about stock splits. We're going to go through what is a stock split, so that way you have a better understanding of what's going on with some of these stocks. Now, if you're looking at a company like Apple or Tesla, you'll know that at the end of August, they both announced that they were going to do a stock split. So if these are companies that you're looking at investing in, or if you already have stock within those companies, it's a good idea to understand what a stock split is. And this is just one of those investing principles that you need to have a good grasp of if you are dabbling in the stock market. So what is a stock split? A stock split basically allows a company to create and issue new shares to current investors. For example, a 2-for-1 stock split, shareholders would get 2 new shares in exchange for each share originally held. While you end up holding more shares, a stock split reduces the price of each share, so the overall value of your holdings does not change at that time. Here's an example of what I mean. Think of one share in a company like a chocolate bar that costs $1. A stock split means that the company could split the bar into smaller pieces, let's say 2 at 50 cents a piece, which would be the equivalent of a 2-for-1 split. You could split it into 4 at 25 cents per piece. That would be a 4-for-1 split, or 10 at 10 cents a piece, like a 10-for-1 split. While the value of the whole chocolate bar stays the same, there are now smaller chunks available at a lower price per piece. In a stock split, the price of a single share decreases, but the number of outstanding shares available on the market increases. This means that the market capitalization of the company will stay the same. So before we dive further into the details, let's kind of go through a few other terms that we should know of. The first one is outstanding shares. And outstanding shares means that they are all of the company's issued shares. The total number of shares is important when you're calculating various data points that measure the health of the company, such as earnings per share, market capitalization, and more. The next thing we need to know, obviously, is market capitalization. Otherwise known or referred to as market cap. It's the market value of a company's outstanding shares. This is the total number of shares multiplied by the price of one share at any given time. And the other thing I want to talk to you guys about is liquidity. And liquidity refers to the ease with which an asset can be bought and sold. Is there a market out there for what you're buying and selling? How easily and quickly can you find a buyer or seller? So let's say, for example, you have a stock and it became really valuable to you and you wanted to sell it to get the cash, but it wasn't very liquid. You might be waiting a long time for someone to actually buy your shares. Whereas if you do have something that is really liquid, it's really easy to turn that into cash. So one of the questions we need to look at is, why do a stock split? So generally speaking, a company might consider a stock split if its price has increased more than it feels is beneficial. For example, if a stock price gets too high, it may deter smaller investors that the company actually wants to attract. Think of Apple or Tesla, and their prices have soared in the last couple months. A stock split can also have a positive effect on market sentiment towards a stock by bringing attention to the company and the fact that the stock price has been rising. Again, much like Apple and Tesla. Liquidity is another consideration. When there are more outstanding shares on the market priced more cheaply, liquidity also tends to increase. Now, we have stock splits, and there's also a thing in which we can have stock splits in reverse. So splits can also happen in the other direction, and these are known as reverse splits, or sometimes they're called share consolidations. So this is the opposite. And if a company feels that the stock price is too low or share prices have decreased to a detrimental level, for example, below a stock exchange minimum share price requirement, it may opt to do one of these reverse splits. And this would essentially be like putting that chocolate bar back together. For example, a 1-for-4 consolidation in which a shareholder would receive 1 new share for every 4 shares currently held. It'd be like taking back 4 pieces of the chocolate bar at 45 cents a piece and returning back with 1 full bar again worth $1. Again, the value of the chocolate bar would remain the same, but now only larger pieces are available at a higher price. In a reverse split, the price of a single share increases, but the number of outstanding shares available on the market decreases. But again, just like a stock split, the market capitalization of the company remains the same. So, what does this mean for you and for your portfolio? Overall, honestly, not that much. If you own shares in a company that splits its stocks, you'll own more shares, or fewer in the case of a reverse split, but the value of the shares will remain the same. While there are examples of stock prices that rise after a split, this would be based on an increase in the number of investors interested in and able to purchase shares at the new lower price. This is by no means the general rule. Also, should you have what's called a DRIP set up, a stock split would mean that your dividend payout would get you more shares of your investment than before the split. For example, if a $100 stock were split on a 2-for-1 basis, a dividend payout of $100 could get you 2 shares at $50 compared to just 1 share at $100 pre-split. So that's also something to consider. Again, if we're looking at the current stock splits of Apple and Tesla, Tesla doesn't issue dividends, but Apple does issue small dividends, so that might be something to consider if you have enough in there to invest. But that is everything you need to know about stock splits. If you got value out of this video, please give it a thumbs up, and please consider subscribing as I talk about taxes, personal finance, investing, kind of everything you need to know from a financial standpoint for both Canada and the US and beyond. So again, thanks so much for watching, and I will see you guys in the next video.